Hey traders, welcome to the Top Tier Outlook. Happy Sunday evening, everybody. Great to see you all. Whether you're catching this live or on the replay, we're here every Sunday from 6 to 6:20 to kick off a look at, well, the week to come. Not just the price action, where are we beginning the week as the ASIN session is beginning, but also what kind of economic events are on the horizon. Last week was the biggest week of so far 2024. We had 5 of the 7 the magnificent stocks report. I'm taking a look at the NASDAQ here on the screen, and you can see the NAS is still clearly quite strong. And if we're going to take a look a little bit under the hood before we get to the magnificence, take a look at the top 4 sectors that are so important to understand why the NASDAQ is up. This is XLK in an uptrend. Green grab candles, green structure, still continuing to move higher. It's the number 1 weighted sector in the NAS. XLC, number 2 weighted sector in the NASDAQ. If you're wondering what is that giant jump, the number 1 weighted stock in XLC is Meta. So obviously, when Meta gets shot out of the cannon because of a 50-cent dividend, obviously Meta skyrocketing higher. Number 1 weighted stock is going to carry that overall sector with it. This is why we have to keep an eye on high concentration weighting as much as we do in the sector sequence mastery. That is the driver. And then when we take a look at what's happening in terms of individual weighting of the sectors within the NASDAQ, this is where knowing where those magnificent 7 sit, not so coincidentally, is within these 4 sectors we're looking at right now. XLY has been a bit of a laggard. As far as XLY goes, this is probably one of the funniest little sectors. I shouldn't say little, but it's a funny sector in the NASDAQ. It's consumer discretionary. Amazon launched itself higher, and this is the number 1 weighted stock in consumer discretionary. But the top 3 are an eclectic bunch. It's Amazon, it's Tesla, there we go, and it's Home Depot. All right, so let's take a look at HD. Now, these 3 stocks make up a disproportionate weighting within the XLY. It's not as if Home Depot is not doing well, but it's sort of stuck. Amazon launched higher, but remember, these are all either working together or they're working against each other. So the number 1 weighted stock is moving higher while the number 2 weighted stock is moving lower. And this is what's happening with Tesla. Tesla's not moving higher, gang. Tesla, of the 7, is probably, well, it's not magnificent at all. And a lot of folks ask, Rog, why do you diss Tesla? I'm not dissing it. It's bearish. It's actually a weight on the broader averages, that it's heavily weighted within the S&P and the NASDAQ. And it's not moving like the other stocks that it is part of in the consumer discretionary corner. Now, some folks ask, Rog, if we were to look at NVIDIA a year ago, if we were to look at other stocks, Microsoft a year ago, is there any chance, is there any insight into why Tesla might be on the launch higher? And, obviously a lot of that's going to have to do with the news around Tesla, the perception around Tesla. That's always part of the conversation. And, we can't not talk about Elon Musk when it comes to Tesla. However, we kind of rewind the clock and say, hey, what did Microsoft do a year ago, maybe 14 months ago? Take a look at something. This is a weekly time frame. This is one of the sessions that we do in the Sector Secrets Mastery we cover macro all the time, definitely at least once a week. And we step back, we take a look at our position portfolio once a month. And this portfolio is not a super active thing. It's a weekly time frame. It's up very nicely since many of the positions that were built in Q3 of 2022 and early 2023. We're looking at setups like this. We're long XLK, for example. But take a look at what Microsoft did right off that 200, right? Let's do the same thing with NVIDIA. So this is the 200 propulsion. Take a look at the structure of when we were neutral, a little bit weak, and then went neutral again. testing the 200 in a neutral environment. Think about what the sequence is that I'm looking for. Neutral environment, not a downtrend. Price at the 200, not below it. And then look at what the precursor was to the uptrend. It was testing the 200. That's NVIDIA. All right, let's do the same thing with Tesla and think about maybe a year forward. We can make a pretty good argument. If you waited for that kind of opportunity in Tesla, it wasn't a great match. It's doing okay, but it's pretty much come back down to the 200. The difference between the 200 visit here, right? And if this kind of stuff interests you, whether it's a 5-minute chart we're looking for setups like this on, a daily time frame, or even a weekly, this time is pretty interesting. This time we're dealing with the 200 in a neutral environment, unlike what we had in early 2023, which, let's face it, that wasn't a bad move. But if I'm thinking about holding something for years to come, that certainly wasn't terrible. If your cost basis is sitting at about $125, right? And then now you're saying, you know, Rog, this is a neutral environment. My cost basis would be right about 195. Not terrible, right? 200 propulsion on the weekly, it works. So when folks ask, okay, Rog, but what about asking ourselves what we're looking at now if we were to fast forward 12 or 14 months, like I just did on NVIDIA and Microsoft, would that be interesting? And yeah, I think it's going to be kind of interesting. So that's one way of breaking down Tesla. All right. And then let's go take a look at how the S&P is faring. So S&P is in an interesting spot. Let's go back to the daily time frame. The S&P is an interesting spot because financials are done. Now the Magnificent Seven are done. And I had one more sector to take a look at in that Magnificent scan, and that's SMH. This is where NVIDIA is number one weighted. So when we look at the highs in terms of NASDAQ, to the individual sectors, to the individual stocks, you'll see really the only two disappointing names, maybe we can say three, are Google, we already looked at Tesla, and Apple. And Google is actually sitting in a spot that I'd like to start thinking about a possible buy. Apple, meh. Tesla, just that's a big cup of nope. But we will start looking at Apple and we will start looking at Google, but everything else is really doing very, very well. And there goes your move in the NASDAQ, right? So think about the individual pieces from the standpoint of the individual sector that are weighted and their order of weighting, and then the individual stocks weighted not only in the index, but the sectors as well. All right, so that's a quick rundown of what's going on post earnings. Now, what about in terms of the FOMC? And I get a lot of questions about that. You know, is the Fed going to cut? And the bottom line, and I'm not going to hedge this in any way. Yes, I absolutely expect the Federal Reserve to cut. I don't believe anyone's doubting whether that's going to happen, although some people might. What I'm going to do is go by the data. This isn't my gut. This isn't anything other than looking at the data, which says March is largely a hold, but it's not just a hold. Even though there's almost 80% expectation that March is not going to be the first month of rate cuts from the Federal Reserve, there is 20% expectation that we could cut. I mean, by no means is it a high probability, but you move out to May, take a peek. This is where the cut comes into focus. 58% that will cut in March, and then a 13% that will cut in March, and we will have already cut that will cut in May, and that we've already cut in March. So look at May. May is dovish. If we're going to get the first rate cut, it's going to be in May. And if this starts to back away, it pushes it out to June. And it's way too soon. I think there's a lot of folks that want to front run Federal Reserve policy. And I will tell you this, because I've watched people try to do this for 2 decades. We try to get cute. We try to say, well, the Fed can't do this, or the Fed has to do that. They can do whatever they want, and they don't have to do anything. So our best bet is to continue to gauge what is expected to happen, because this is how equities and treasuries and currencies and indices are going to move now. Our trading isn't about front running what the Federal Reserve is going to do and basing our position on that. Our trading is how are expectations changing, and then how can we trade those shifts, or how can we trade the probabilities, right? We don't really need the Fed to do anything. It's all about the expectations we have about what they could do. And case in point, you might say, Rog, but how does that help us? We as collectively, as traders and investors, are expecting the Fed to cut rates. And we've been talking about this since last year. The NASDAQ is at new highs. You know what's really bullish? New highs. New highs are really bullish. Whether that be new highs in a day, new highs in a month, new highs in a year, all-time highs, they're bullish. They're never bearish. Yes, we could pull back, but generally speaking, new highs, probabilistically, let's not take an exception. Probabilistically, they're really stinking bullish. It has paid to be a bull now for over a year, right? Doing anything but expecting higher highs, doing anything really but buying the dip and staying bullish has been the less profitable side. Now, yes, I'm sure some folks picked every top. Sure. I'll humor that. Picked every top and shorted it, or whatever it is. But the rest of us who can't see the future, yeah, I'm salty in 2024. The rest of us that can't see the future are going to do what? We find the trend in macro, we find the trend in the indices, and we take advantage of the overall move higher. So that is what I will tell you all. Please don't start to subscribe to traders who are going to start talking about new highs as some sort of preparation for a dramatic sell-off. If that happens, let someone else pick the top. Broken clocks twice, right? Twice a day, right? Let someone else do it. And then we'll do what? We'll step in and buy the dip. Great. I mean, someone needs to drive it lower for us, and I'm grateful for that. But that's not what I'm going to be looking for. All right. So let's take some questions here. And let's see. Glenn asks, what are my thoughts on playing seasonality? Not this year, Glenn. Whether that be S&P, NASDAQ, Dow, Russell, treasuries, currencies, not this year. And here's why, Glenn. If we had a year where the Federal Reserve was not going to be active, if we had a year where we weren't expecting a dovish pivot, we could start talking about seasonalities. But seasonals are a funny thing. We have cycles in equities, and one of the cycles we have coming up is an election cycle, right? But if you think about what a seasonal is, a seasonal really was born of things that are planted, grown, harvested, stored, things that are sensitive to weather, things that are sensitive to shifts in weather patterns. They're alive, right? And so seasonals were really your corns, your wheats, things like that. Now, there are cycles that can affect the stock market. The cycle that we're coming upon is a dovish cycle. It's not something that happens every year. It's not that it's on some sort of cyclical, calendar-oriented rotation. But election cycles can be rather bullish. If you go back and look at the year, election cycle years, they tend to be kind of bullish. So you add the bullishness of an election cycle, you add the bullishness of a dovish pivot from the Federal Reserve. I don't have any opinion on seasonality in equities this year, and I try not to rely on them too much. There is a sell in May and go away, right? Which seldom means what people think it does. There are Santa rallies, there are end of month rhythms. There are certain rhythms that will continue to be applicable, but they're much shorter. They're much shorter things. For example, dividend, paying ourselves at the end of a month. There's usually a lot of redemptions at the end of a month. Folks pay themselves. Reinvestment at the beginning of a year. So the last 3 to 8 days of every month sometimes have a bearish tendency, while the first 3 days of the new month have a bullish one. We have end of quarter rebalancing or things of that nature that can happen. But those would happen, anyways. I wouldn't call those a seasonal. They're more just a process of the cycle that stocks go through as we begin and end a month, or begin and end a quarter, which is far more volatile than the month. So those are all the reasons where I say it really doesn't matter, because there's no true seasonality, in my opinion. to the stock market because I'm not looking at something that has to move because of weather patterns and such. Now, there's some seasonality to consumer behavior. This is true. And I think that's where some of the optimism about Q4 can come. But let's remember the two overarching narratives are most definitely going to be the election and a dovish pivot from the Fed. So thank you, Glenn, for the question. All right, Srinivasa, S&P started its uptrend at the end of October and is up almost 20%. So much of AI hype, Fed rate cuts, and electronic elections, but bottom line is earnings. No, bottom line is not earnings. No. And fantastic, you joined the mastery. Excellent. No, bottom line is not earnings. Oh gosh, that's the biggest lie ever told in markets. That equity trends rely mostly on earnings. Oh gosh. And I know folks out there who study fundamentals are going to go, Rog, what are you talking about? No. Federal Reserve monetary policy has far more influence over what equities are going to do, not because it necessarily changes whether Apple's going to sell a bunch of their goggles or phones, or whether Microsoft is going to have a good year, whether Tesla's going to sell cars, or GM for that matter, or anything. Monetary policy is far more overarching, far more influential than the earnings of companies. Company earnings create a lot of volatility, and cumulatively, traders might say and investors might say, well, revenue, earnings, dividends, they definitely help the trends continue. I mean, let's take Meta, for example. Let's take a really dramatic example. Wasn't Meta already pretty bullish for the better part of, we can argue, all of 2023 and into 2024, right? Were every one of these earnings blockbusters? I don't know. But I can tell you that overall, what happened in 2023? The broader averages rose despite rate hikes from the Federal Reserve, but the broader averages rose. One of the things that's really interesting about why money flows into stocks is a simple question. Where else could it go? Right? Where else could money go? So then it becomes a comparative process, right? It becomes dividends. Are dividends in any way a competitive payout versus just being in the equities and kind of looking for alpha? Are yields at a level where they're competitive? So a lot of folks look at trends in dividends or trends in yields to say, well, people might not buy stocks and buy this other thing instead. It's not about a trend really in the yield. It's more about a tipping point. So it's really comparing the dividend of certain stocks or certain types of ETFs, or the yield of a bond, short or intermediate or long term, versus what a trader could expect just being in an uptrend and say tech. So it's more of a tipping point. At what point is another corner of the market more appealing? And so that's the way I look at that. So I will continue to expect the market to trend higher because that's what it's doing, right? That's what it's doing. And this is where physics is really something we should focus on more than what economists and analysts say. A body in motion tends to stay in motion. Let's always presume continuation, because for every retracement in a trend that we get that just keeps going from retracement to reversal, that's far less common than continuation. Correction to continuation, or retracement to resuming the trend is far more probable. Traders who feel that every pullback is a reversal of the trend are really going to lose out on the sale that a buy the dip yields. Buy the dip is far more going to outperform trying to pick a top or presuming that pullbacks are reversals. And I know that may not be popular, but if you take a look, history proves that to be true. There is an overall bullish bias in equities. And there's certainly going to be one election year if we look at the sort of the cyclical nature of it, kind of going back to Glenn's question. And when we go into a dovish pivot from the Federal Reserve, stocks love cheap money. Stocks love it. Why? Well, first of all, as rate cuts come, yields drop. As yields drop, well, where are we going to go seek alpha? Where are the returns going to be? And it sort of drives traders and investors right back into stocks. it drives them right back into stock. So yeah, great to see you. Hey, Srinivasa, yeah, now that you're in this service, check out the video from the 23rd. I believe it's the 23rd of January. You can go back into the archives, and I did a full breakdown on our portfolio. So you get to see what have we been buying, how we've been buying it, and what our cost basis is. So, I don't have to say, you don't have to just take me on my word here in our 20-minute show, but rather you can go back now and say, oh, Rog, you're long tech and you're long a number of things in the context of parts of the year like 2022 where people said, oh, everything's going to hell in a handbasket. And we went right back to those structures and those sequences on the weekly and said, nope, this is where we want to build a long position. So yeah, definitely check that out. I'll see you in the chat room tomorrow, our trading room tomorrow. And by the way, for those of you that are in the Simpler Central room or the Sector Secrets Mastery this week, and also over at countdowntrader.com, I'm going to be showing you all my trades viz from January, which shows the trades taken in the Sector Secrets Mastery. And look, my trades and the Sector Secrets Mastery trades, they're one and the same. Whatever I'm doing is what I alert. So we're going to go through the swing trades. And if there's anything that's sort of the theme for 2024, it's been the theme throughout my career, but I want to bring it to the forefront every single time I'm talking to you all. Account growth. That is it. Not a hot stock, not a great single trade. At the end of every month, account growth, because the only P&L that or the only trend that matters is our P&L. Does the NASDAQ trend matter? It's nice. Does the trend in bonds matter? It's nice. But the only trend that really matters is the uptrend in P&L. So we're going to talk a lot more about that this coming week as I pick apart and show you what we did in January and where my account sits as we start off February. In fact, I'm actually capturing a lot of those charts. I'm actually looking at my other screen. I'm capturing a lot of those charts right now and our alerts to show you, hey, this is when we bought it. This is what we did. This is how much the option cost, all that good stuff. So it's quite a few. We were pretty active with the January swings. All right, gang. As always, thank you so much for being a part of Top Tier Outlook. I'll see you tomorrow for Charts and Coffee. Be good to each other, gang. Until then.